And this is where now it goes back to the velocity of money, where now the faster that you can grow your money, the faster you can invest your money, the wealthier that you're going to be. Let me start by showing you why the velocity of your money is so important here. If you can invest $500 a month and you do this for 40 years, the amount of wealth that you're going to build is going to depend on the velocity of your money, meaning what type of rate of return that you get. Whether you get a 5% return annually, a 7%, or a 10%. Now, this doesn't mean that you're going to get this return every single year. I'm talking about the average. So some years you might lose money, some years you might make more money, but on average, if you get a 5, 7, or 10% return, it's going to determine how wealthy you will become. And all three of these numbers are very accessible and achievable. Just depends on how much education and time and work you're willing to put into your passive investments. If you get a 5% annual return on your money, you're going to end up with about $750,000 with your $500 monthly investment. If you get a 7% annual return, you're talking about $1.2 million with your passive investments. And with the 10% annual return, now you're talking about $2.9 million worth of wealth from your investments. That's a big difference between here and here, but it's both very accessible. It just depends on what is the velocity of your money and how fast you can grow your money. Let me break this down. The velocity of money that you're going to get is going to depend on how much risk you're willing to take on and how much work you're willing to put in. So the way we can break this down is now understanding the difference between being an active investor versus being a passive investor. And we can start by talking about this in the stock market because that's probably the most accessible and easy way to understand the way that it works. In the stock market, there's a couple of different ways that you can invest your money. You can invest your money by putting your money into individual companies, like the Amazon stock. If you invest your money in Amazon, you are betting that Amazon is going to grow, make more money, and become more valuable. Now, in order to do that and actually make money, you're going to have to put in the work to learn about the Amazon company, to study the Amazon financials, learn about their products, keep up with the company's doing, and make sure that the company is on track to continue growing. That way you continue to make more money. That's option one. That's more of an active investment. This is what Warren Buffett is doing. He's spending his time learning about companies, reading their financials, learning about who's running the companies. That's what his life revolves around. Is to study companies, find companies that are undervalued, buy them, and hold them for a long time. Option two is being a passive investor. This is where now instead of investing in a company like the Amazon company, you can invest in a fund that will give you exposure to a lot of companies. For example, there are ETFs, exchange traded funds, that give you exposure to the S&P 500. One example of this is SPY SPY. SPY will give you exposure to the 500 largest companies in the stock market. So if you go out and invest in that one ticker symbol, I'm not telling you what to invest in, just giving you an example. If you go out and you invest in the SPY ETF, you are going to own essentially 500 of the largest companies on the stock market. One of those companies is Amazon today. So now, you don't have to go out and learn about all 500 of those individual companies. You're just investing in that broad group. Now, your risk is much less because if one of the companies you invest in goes bankrupt, you have 499 other companies to balance it out. But that also means your upside is limited because if Amazon were to take over the world, well, yeah, you're going to benefit because it's in your ETF, it's in your fund, but it's going to be balanced out by some of the losers. So lower downside, lower upside. And you also get to save a lot of time because now you don't have to worry about so much Amazon and what they're doing, what their products are, who their executives are. You don't have to study their financials. So now as a passive investor, you don't have to worry so much about what is going on with the individual companies. You just find the right fund. And the way that you win is you create a system where every week, every 2 weeks, or every month, you just continually keep buying more of those funds. It does not matter if the market's up. It does not matter if the market's down. You just keep buying more no matter what. That's how you build wealth over the long term, is if you invest in funds that give you broad exposure to the markets and you just continue to ride the market because now if the American economy grows, your thinking is that these funds will grow as well. With the individual companies, it's different because now you have to find the right company and you have to own it for the long term and you have to make sure that this company continues to grow because now if you invest in the Amazon company and they go bankrupt, you just lost all of your investment. But if Amazon takes over the world, now you can see a huge return on your investment. So you can start to see that risk and reward. The more risk you take, the more rewards that you can get. If you want to be an investor in individual companies, you better be investing in your financial education of learning how do you analyze companies, how do you study financials, how do you learn what an income statement is, how do you study cash flow statements, how do you study balance sheets, how do you actually value the companies. This is a whole education in and of its own. And the more you learn, the better you're going to be able to do. Anybody can go out and invest in a company, and yeah, maybe you'll hit a couple of good companies here and there, but if you really want to increase your odds of good returns, and you want to increase the types of returns that you get, that's where you have to be investing in your education. On the passive side, it requires much less effort on your end. Now, you don't have to pick one or the other. I am both. I have a system where I am passively investing my money, and I also actively invest my money. I have a system where every week, for me it's every Wednesday, I don't have a special sauce or science for why Wednesday. I just do Wednesday because I used to have it on Monday and Friday, but then sometimes the markets will be closed on Mondays and Fridays, so I just pick the middle of the week. But every Wednesday, I have cash that's pulled out of my checkings account and is automatically invested into my portfolio of ETFs. I have ETFs that give me exposure to value. I have ETFs that give me dividends. I have ETFs that invest into international companies. And I have ETFs that invest in innovation. So now, every Wednesday, I have cash pulled out of my account that's invested into these ETFs. There's a bunch of great platforms that specialize in this for you. I have the company who is an affiliate of mine, meaning if you use them, you will get compensated. Down in the description, if you want to learn more, but you can do your own research, find the right company for you. The company that I use is called M1 Finance. I like them just because, well, it's super simple. They specialize in this type of passive investing. So I'm a huge fan of them. But again, I want you to do your own research. If you want to learn more about M1 Finance, I got the link to my affiliate code down in the description if you want to check them out.